Good morning. My name is Paul Reichel, excuse me, and I'm a member of the Financial Matters Committee of the Retirement Association. Today's speaker is Ken Wundrow. He retired in 2017 from Meninga Tax and Financial Services. Over his 38-year career, Ken worked with hundreds of clients, assisting them with their taxes, investments, and other financial matters. Additionally, he was the firm's financial matters and trained the other staff at Meninga. Ken has lectured at hundreds of seminars and workshops over the years. He presents his information in an understandable, instructional, and entertaining manner, and often cites practical applications from his own experiences. And as you may know, he continues to give presentations to groups such as ours. Ken is now volunteering for the SCORE organization, where he consults startup companies for them to achieve success. This is Ken's 14th time presenting to our association.
Wow, I don't know if I feel really old, extremely pressured, or as my wife says, my wife reminds me all the time, it's not all about me, and that sounded like it was all about me, and I don't know, that was thank you, but I don't know how I live up to all of that. I have been busy with taxes in my life for, as Paul said, 38 years. I overlapped with an education career in there where I taught 7th grade. That's why I can make everything understandable, because I needed to make it understandable for 7th graders. I did that for 25 years, and those two careers overlapped. As Paul said, I'm now currently volunteering with SCORE. I still teach tax law for CE credit to about 1,400 tax preparers across the state of Wisconsin each year. How long I'm going to continue to do that, I don't know, but so far we're still doing that. With SCORE, I joined SCORE in February of 2018, and it was kind of a perfect fit, because with SCORE, we go out and we mentor small businesses. Some of them are in dream stage. They're still thinking about what they want to do. Some of them are in startup stage, so they're at various points in that journey for them. Some are up and running. SCORE is a free service to anyone who is trying to get a business to grow or succeed. Our services are free to them. They can use us as often as they want to. We offer workshops for nominal fees for group settings, but for the most part, it's one-on-one mentoring with the business owner. We'll talk about anything from tax entity, how they should form up, to payroll, to hiring an employee, to independent contractors, to eventually pricing their product, marketing, and potentially even selling the business at the end. So we've worked with a couple of businesses that after 5-6 years have built them up to the point they want to sell them. So it's very rewarding. And the only reason I bring it up is if you have anybody out there that you know that's in that position or has started a business, there's consulting, whatever the case may be, and they're looking for some advice, or maybe just someone to share their stories with. That's what SCORE does. We have offices down at the MG&E Center just down the road, and they can call into that office and they're assigned a mentor based on what they need. I wind up getting a lot of work out of them because of the tax background, because when businesses start up, the first questions they have is, how do I handle the taxes? What entity am I supposed to be? And what I try to do is counsel them in the services that make sense for them to pay for and the services that they shouldn't pay for, or at least not pay for until they get to the point where they're large enough to need them. So that's a little bit of background. I've had a busy summer. We made it to Alaska on a cruise. We made it to Reno. I went up there for a conference in August. Reno is hot in August. So my sisters came over from either side of the mountain. One lives down the range, and the other one lives over in Sacramento, and they met me there. And we spent an extra 3 days after the conference, and we went up into the mountains, and we had just a really nice trip. And then I finished my year. Just spent 6 days in New York City. The theme for this year was we went to all those places there. We had met people somewhere along our travels who had made the fatal mistake of saying, if you're ever in the area, stop in. New York was one of those. In March, we actually traveled all through the Southeast. I went to 4 different friends who had done that. We emailed them before we left and said, remember you making that statement? Well, we're in the area. Every one of them came back and said, come stay with us. We spent about 4 days at each place and just had a really nice, relaxing trip. So that was my summer. So let's talk about tax cuts, tariffs, and treaties. It's been nice. Since I left Menega, when I was working with Menega, I was in the financial industry. I was doing investments for clients. The tax area has a lot of compliance rules. There's things that I have to stick to when I address a topic. But with investments, it was very, very tight. There was almost nothing that you could say, and if you were going to speak to a group, they monitored everything you said. They'd look through your script. So if I wanted to talk about investments, I had to give them a script ahead of time. Then I had to prove to them that I stayed on script, and God forbid I never, ever said the word guaranteed. The only thing that we could guarantee was our service, but we couldn't guarantee anything else. Now that I am away from that, I've let my investment licenses go because I'm not associated with that broker-dealer. I'm still my EA for taxes, and I still have my insurance license. But what's changed is now I can bring some of those investment topics into here. Again, I'm not going to tell you anything that's not true. I just want to make sure that we put it against the backdrop. When we talk about taxes, taxes impact your investments, and your investments impact your taxes. And when you ignore the fact that those two things go together, you don't have the efficiency that you want in your investments, and you don't have the savings that you want in your tax law. So we kind of blend them together. And that's what this is going to be about today, to try to bring those together. So with tax cuts, the first one I want to talk about in here is the Tax Cut and Jobs Act. We'll go through that. Now, that was passed in 2017. It was active in 2018. How many people in here in 2018, when you did your taxes, feel like you got more money back? Wow. Okay, we got a couple hands, all right, maybe 3 hands. How many people in here think that they actually paid a little bit more on taxes? Got a bunch of hands. How many people just don't really know? Okay. The whole thing with the Tax and Jobs Act was that it had 2 impacts. One was on small businesses, okay, actually not just small business, but corporate America. And then we threw in this little thing to kind of help out small businesses called that 20% deduction. And then the other side was directed at, quote unquote, simplifying the tax code. Well, what they did to simplify the tax code was basically carved out of the tax code enough money to pay for, or at least try to pay for, the corporate tax cut side. If you've listened to me more than once, you know that the one thing I'm going to do is I'm going to stay as neutral as I possibly can, because there's a lot of you and one of me. And I'm not these people that go out to politicians and want to debate. So what I'm going to do is I'm just going to tell you basically what's the backdrop. The Tax Cut and Jobs Act cost a lot of money because of the tax cuts that we threw out on the corporate side. To balance that out, one of the things that happened on the individual side was we got limited on property taxes and income taxes. So that was limited down. The second thing was the exemptions were taken away. So you don't have that personal exemption anymore that's in there. And then the third thing that they did in there was they increased the standard deduction, which basically kind of took a lot of people out of the line of itemizing. So one of the things that I'm going to talk about in here is how that change has impacted the law, how you can still maybe double up and get some itemized in there, but you have to do it, you have to approach it differently. So we'll look at that. The other item in there, we're going to talk about tariffs and treaties. And the only reason I threw them in there was because they're pertinent. They impact taxes and they impact the investment side. But most people really are confused because they're listening to two very different arguments going on in the media. So where is the truth lying there? So what I'm going to do is just tell you basically straight up how tariffs and taxes or tariffs work and how they affect taxes. Third piece, annuities. I just want to make sure that that's become a hot topic, and it's becoming more of a hot topic, again, because of the changes that have been made out there. So I'll just talk about those, and at the end, I'm going to allow time for questions. If you have questions as I'm going along with this, if they're directed right at the topic that's up on the screen, and it's generic where it would help everybody in the crowd to ask that question, go ahead and ask it, and I'll try to repeat it so everybody hears it. If it's more targeted towards you specifically, or maybe something that rang a bell up there, but it's not really about that, come see me after or on break, and I'll try to answer as many questions as I can. So without further ado, what has changed in this whole thing? It's harder to itemize now. Income and real estate tax deduction was limited. That's referred to, when you hear them talking about it, it's called SALT, S-A-L-T. It stands for state and local taxes. That's what they did. And they said, we're going to collapse that down so that the most you can take is $10,000. Well, if they limit me down to $10,000 and I live in a house that in Madison, a $270,000 house, which is kind of the median, you're running $6,000 to $7,000 of property taxes on that property, all right? Add in your income taxes, and pretty quickly we're up to that $10,000 number, and that's as far as the tax return will let you go. So that took a lot of people down from where they wanted to be. The other issue in there is with state taxes in here, some of you may not be paying that much in state income taxes anymore. Your tax hit is on federal, because they're taxing your Social Security and they're taxing your pension. But when you get to the state side of the whole process, they no longer tax the Social Security. So if I take the Social Security out of the equation, in a lot of cases, I've cut your income at least in half. And when I run through the state, turns out that where I used to be paying $3,000, $4,000 to even $6,000 in state income taxes while I was working, I'm suddenly dropping down to some pretty low numbers. The other thing on the state is the state still gives us a credit for our property taxes, and that's $300. And they still give you a credit, even if you can't itemize for federal, the state still gives you a chance to itemize your charitable contributions and your medical contributions. Now, that doesn't always work, but in some cases it will, because your standard deduction is low because of your income. So what turns out is, for a lot of people in this room, that limitation down to $10,000 really didn't affect you as much as you think it did. And because of that, some of you can still itemize, or even if you don't itemize, you're still coming out okay on federal taxes in there. I want to go back. I feel like I'm missing a slide in there. I guess I'm not. So harder to itemize, miscellaneous deductions are gone. I don't think that impacts a lot of people in this room except for, so let's talk about miscellaneous deductions for a section. Miscellaneous deductions was on the bottom of your itemizing. The last deduction that you could try to take was miscellaneous deductions, which applied to, number one, any financial fees that you were paying. The cost of having your tax return done was a miscellaneous deduction. Education expenses, if you were continuing ed, you could possibly have tuition or book expenses down in there. Professional journals and professional dues were in there. Well, that was taken out of there altogether. If you used to itemize those kinds of issues, that greatly reduced your ability to itemize. That took you kind of out of the realm really fast. The other thing it took out was the employees who wanted to have an office in their home. That was the only place you could take that. But here's the good news. Though they took that miscellaneous deductions away, they left the ones that were not limited. So you can still gamble and take your gambling losses, okay? You can still take your final estate or trust deductions. So if you had an estate that was closing out and it had a capital loss, or it had fees for the executor, or the cost to do that tax return for that estate, those can slide through down in there yet. So that still exists. The problem is, if you don't itemize, it still doesn't help you. So here's the caution. I'm not going to ask you to show hands, but if you're gamblers and you've got some winnings, in the past, this is what I always heard as a tax preparer. Well, sure, I got this little slip here that says I won $18,000, okay, but I lost that much easily. All right, in the past, we'd go $18,000 on the front page, and then we'd get to itemizing, we'd take an $18,000 deduction. Okay, all of a sudden now, you can't itemize, the $18,000 gets taxed, but there's no way to take your $18,000 of losses. So you have to be cautious in there. If you are gambling, understand that that might cost you a little bit more in taxes now. There are ways. How many people, has anybody in here heard of session gambling? Nobody knows that topic. If you do gamble, the government does give you one break. It's basically, this is how gambling winds up on the tax return. I go out to the casino and I'm playing slot machines, and I'm really probably not keeping track of what's going in and coming out, but suddenly I get a win that's more than $1,200. Well, as soon as it's more than $1,200, they're going to make you a 1099 that goes to the government and to you, and it says, you got $1,200 of winnings, you're going to have to put them on your tax return. Well, the truth of the matter about gambling is all of your winnings are supposed to go on the tax return. So here's an example. I go out to the casino at 9 in the morning and I start gambling slot machines. And I had $500 when I walked out there, and I started with my $500. At the end of the day, I walk away from the machines and I only have $400 when I cash out. What apparently happened that day? I lost $100, right? And it would be nice if we could tell the government that and they believed it, but the government says that's not what our records show. Because around about 11 o'clock that day, I got lucky. And I hit a jackpot, and I got a 1090 or a W-2G from them for $2,500 win. That's what it said. Most people would come in, they would never tell me what happened during that day. They'd just show me that $2,500 slip, and I'd have to put $2,500 on the tax return. The reality is, what happened to that person that day? They came in with $500, they won $2,500, so they were up to $3,000, and at the end of the day, they had $400 when they cashed out. They didn't lose $100. They lost $2,600, okay? What goes on the tax return? If you kept track of your gambling as a session, you kept a diary all day long of that, you would have zero to report on that day for taxes. Zero. You wouldn't have to put that $2,500 onto the tax return because you could show from your session that you actually lost it. That's the difference in session gambling. If you're gambling and you're hitting winnings, I know the other things that happen on that return. You put that income on, and right away you're paying more tax on your Social Security, your medical. If you were itemizing, your medical got harder to get. And if you get enough money on there, if you get up to, this is going to sound like a big number, but $170,000 of earnings on your tax return, do you know what else happens? Medicare. So I don't know who said it. Okay, right there. Your Medicare premium goes up because Medicare is a means-tested process. So the government says if you can pay more for your insurance, you should pay more for your insurance. So just a word to the wise. You may not be itemizing, so you're going to have to be much more careful about seeing if you can keep those gambling winnings off your tax return. No more home equity interest deduction. That probably isn't bothering a lot of people in here, but what it says is, in the past, I bought my house for $150,000. I had a loan, a mortgage on that, and over the course of years, my house is now worth $300,000. I have $150,000 of equity, and I would like to buy a new Tesla, but I don't have the cash to do that, so I go down to the bank and I take an equity loan for as much as I need, and I used to get to deduct that interest. Now you can't anymore. The only interest that you can deduct on there as an itemized has to be spent on your house. If you spend it on something other than your house, you don't get to deduct it. So that's another thing that got taken away in there and greatly limited. And then finally, no more personal exemptions. They took those away. Okay, personal exemptions were up to, ever remember what it was? $4,000. So $4,000 per individual. So on a married filing joint, you were allowed to take an additional $8,000 off your income after you were done with everything else on it. It was the last step before you figured your taxes. That's been taken out of there as well. There is good news, the standard deduction increased. So this is how they offset it. So standard deduction for a single is now $12,200, and for a married filing joint was $24,400. That is just about double what it used to be. So we've got more standard deduction, less itemized deductions. More people now have, Congress told you, a simpler tax return. And that is true. That's a truth. It's a simpler tax return. Did you come out better? This person sitting here will have a different story than she will, than he will. Okay? Of the three of those, two of them might have came out better because they were never itemizing by much anyway, and now their taxes are simpler and they've got a big standard deduction, so they really have reduced their income. But he was a big itemizer down here, and he just lost a big chunk of his itemizing because he lives in a really fancy house, and he's still working on the side, so he's got state income taxes. Well, now he can't have all of those. He used to do a miscellaneous deduction for a bunch of stuff. He pays his investment counselor a lot of money, and that's gone. Okay, so now he's stuck. He's got more income than he did before, and he pays more taxes. That's why when I polled the room, I wasn't surprised by the number of people who felt they paid less, the number of people who felt they paid more, and the number of people who said, I really don't know. Unless you compared your tax return year over year, you wouldn't know that. Additional standard deduction for age and blindness still exists. That's important to understand. For a single person, it's $1,600. For a married filing joint, it's $1,300 per individual. So we just got done showing you that your itemized deductions were $24,000, or not itemized, but standard deduction was $24,400. Well, to that, if we're a married couple and we're both over 65, we can add another $2,600 to that standard deduction. Okay, and then unfortunately, if one of you, or both of you for that matter, are blind, we get to add that $1,300 again for the blindness. So example over on the side says a single taxpayer over 65 and blind, which was my father at the end of his life, his standard deduction nowadays, if I were doing his taxes, would be $15,400, $12,200 plus $1,600 twice. So $12,200 plus $3,200. So that still exists there. That wasn't taken away. The catch is it was also never changed. It's not set to inflation. It's going to be a flat number that just stays there that way. And it's not well defined in the tax code, but it's in there. Doubling up deductions can still work. You know that I always talked about that. Doubling up deductions meant this. In the past, I could do all my charity twice within the same year. So I gave $5,000 to my church and $1,000 to United Way. So I had $6,000 at charitable. But then in December, I wrote another check to my church for $5,000, and I wrote another check to United Way for $1,000, and now I had $10,000 of charity within the same year. That has not changed. Everybody can still do that. What changed was the other item that we doubled up, which was our state income taxes. We did those with an estimate at the end of the year of what we thought we might have to pay the year coming up. And then we doubled our property taxes. Doubling property taxes meant that somewhere along the line, I had shifted to paying my property taxes in installs in January and July. So I paid my 2018 taxes in January of 2019, and then finished them off in July of 2019. And now coming into December of 2019, I'm getting my bill in about another 3-4 weeks. Prepare yourself for that. When that bill came, I paid it in full before the end of the year, and now I had not $6,000 of property taxes, but $12,000. And there's the problem. How much heck can I take? I can't take the $12,000, I can only take 10. Okay, and along with only taking $10,000 of my property taxes, how much do I get for my state income taxes? The answer is nothing. That's all over the top of that $10,000 limit. That's where the damage was done to doubling up. But I'm going to come back to and remind you, two of the items that a lot of people in this room are using for doubling up is charitable, because you're a generous group. I'm betting a lot of you still give money back to the university. Okay, and then the second one is our medical is more expensive after we stop working. Not quite as expensive as we think. It's not the premiums. It tends to be the deductible, the dental, the optical, the other things that we have now that we're having done. Don't forget acupuncture in there. Don't forget long-term care insurance. Those are all medical deductions. So we could still potentially wind up beating that $24,000 if we're a high charitable giver. We have $10,000 worth of property taxes and income taxes combined, and we have some medical that's coming through. So don't miss that one. Doubling up on charitable. Let's talk about two ways that are very, very efficient. One, the first one is consider transfer of appreciated investments. So since 2009, the market has gone which direction? Up. We are sitting just below records right now. We're still up there. And in fact, on the S&P, as of 2 days ago, it was still at a record, okay, or as of last week. Because of that, that means you've got stock investments out there, you've got mutual fund investments out there that have greatly appreciated in value. If you sell them, you have to report that income and pay taxes on the capital gain. Now, the capital gain treatment is nice. It's a cheaper tax rate, but you still have to report it. If instead I took and transferred that to the church or to the United Way or to Salvation Army or whoever your favorite charity is, the University of Wisconsin, if I transferred that investment to them, I get to ignore the income that was capital gain. Instead, I get credit for the entire fair market value of it. So the easiest example, I have a stock, ABC stock. An ABC stock, when I bought it, was worth $10,000. I bought it for $10,000. It is now worth $21,000. So I have $11,000 of gain built up in that stock. If I sell the stock, I get the $21,000, but I also get to pay taxes on $11,000. If instead I turn around and say to my church, you know what? Here's the stock. I'm going to give it to you. I'm just going to title it over to you. The church sells it, gives you credit for a charitable contribution of $21,000. The tax return says you have to report nothing. There's no income that's going to come to the tax return, but you get the full $21,000. How does that work in doubling up? What a lot of you are sitting on is those kinds of investments. If I gave that to the church, let's say that normally I give $4,000 to the church, and now I transfer a stock over to them that's worth $20,000. Well, basically, I just gave them how many years of my donation? I gave them 5 years. For the next 4 years, every time they pass the plate by you, throw a little note in there that said, already done it, okay? Don't hit me again. The church never gets upset. No charity ever gets upset with getting all their money up front. The only thing is they will not stop asking you for more. So So you got to be persistent in saying your no or finding some way to let people know you've taken care of it ahead of time. Now in that tax return, I got a big charitable deduction, throw in my $10,000 of taxes, throw in some medical that's in there, maybe even a little bit of mortgage interest if it's left over. I itemize, I get a nice tax savings that year, and in the next 4 years, what will I do? I'll avoid paying anything. I'll stretch my property taxes out. I'll stretch my medical out. However, I won't itemize, but I'll get that nice big $24,000 standard deduction, and I will continue merrily along. Those people are going to save lots of money. That's where the savings is in this thing, and that's what I wanted to make sure you understood. Beware the $10,000 tax deduction. I talked about it. One other topic on there, it's not on the screen, but we need to talk about it. How many people have heard of donor-advised funds? Okay, good. Donor-advised funds have been around for a number of years. They are suddenly going to become very popular. Very popular has two qualities, two advantages for someone, for anyone in here. If they become very popular, that means more money is going into them. If more money goes into a fund, what tends to happen to the returns? Tends to enhance the returns because they have more money to work with to buy different and broader investments to make money for the fund. The second thing is that those funds are going to kowtow to what they promised to do, and that was to help you funnel money from the fund out to charities. They've made it so simple that most of the donor funds out there now will issue you a checkbook that you can write the checks out to the charity. You just can't write them to yourself. You can direct where and when those donations go out of that donor-advised fund. So here's the example. I'm in the habit of giving $6,000 to charity every year. Right now I have some appreciated stock, or I have some money around, and I'm going to put it into that donor-advised fund. So let's say I put $40,000 into that donor-advised fund. I don't have to push all that money out of the fund in that first year, but I still get the $40,000 deduction. Now at the end of the year, I go, let's send my $6,000. Let's send it, $3,000 goes to my church, $2,000 goes to United Way, and $1,000 goes to Salvation Army. There's my $6,000 I gave out of the fund. I still have $34,000 sitting in the fund, plus whatever the fund earns in growth, okay? Because it's in a donor-advised fund, none of that's taxable to you. But all of it is deductible to you, as long as you keep track of when it goes in. So that will help people who want to try to double up. Only disadvantage to donor-advised funds. We're going to hit it in the next couple of screens here. They do not take transfers from IRAs. So you can't do that qualified charitable deduction, which we'll talk about. Different approach, qualified charitable deduction. The qualified charitable deduction says that, again, I want to give money to a charity, and I have money in my IRA, and I'm over 70 and a half years old. What happens when you hit 70 and a half years old and you have an IRA? You got to take required minimum distributions. Now, if you have $100,000 in an IRA, the minimum, in other words, your first required distributions coming out of there are going to be about $4,000. If I just happen to be giving about $4,000 to my church, what I get to do is direct the custodian of my IRA to send $4,000 directly to my church or whatever charity I name, University of Wisconsin. I'm going to keep plugging the University of Wisconsin. But I send them that money. I've satisfied my required minimum distribution, and I don't have to put any income on the tax return. The only payback, I can't skip the income and take the deduction. I can't have both. That'd be double dipping. But I don't put the income on the tax return. I turn around, instead of itemizing, I'm taking standard deduction. It's a win-win. My $4,000 never hit the tax return, which meant it never nicked my Social Security. It never bothered my Medicare premiums. It didn't get in the way of anything else, and I didn't have to pay the taxes on that, but I satisfied it. That's how a qualified charitable deduction works. The only catch is you cannot put those into donor-advised funds. And if you're looking for the logic, if you're saying, oh, but Congress will fix that, no, they won't. Here's the reason. Why do you have a minimum distribution requirement on your IRA to begin with? What's the government want? They want their tax money, all right? That's the first motivation. So they said, start draining those things down. You've been hiding this income for years and years and years. It's time for you to pay the piper. We want some tax revenue. Number two, why do they want you to spend that money out of your IRA? Where does the money that comes out of your IRA, where are you spending it? Where's it going? Directly into the economy. And if we put money into the economy, we make the market happier, we make businesses happier, businesses make money, and eventually the businesses then pay taxes on that money that you spent. So they're gonna tax you when it comes out, and they're gonna tax whoever gets it, because that's gonna be profit to them. So the government is not gonna take that donor advised fund away, because what would happen if they left you transfer your IRAs into donor advised funds? I'd transfer them all in there, I'd never pay taxes on them ever. Okay, but would the money get spent? No, it would sit inside the fund until I felt like giving it out to some charities. It's too slow. It's like a train that's stalled on the tracks, and we're expecting it to start rolling on its own. It's gonna need a push. Okay, and that's what IRAs are about. IRA distributions are to push that money back out into the economy. So I don't think they'll ever become part of donor advised funds. The keys in there, remember that they have to come from an IRA. They cannot come from your 403B. I say this every year, and somebody always comes up to me and going, you're kidding me, because all my money's in a 403B. What do I do? If your money's in a 403B and you want to do this, you want to do qualified charitable distributions instead of taxing your required minimum distribution, move some of the 403B over to an IRA. If your 403B was with the university, odds are it was probably in Fidelity or the ETF funds, okay? Open an IRA in either Fidelity or ETF funds, and you just roll it from the IRA to the same funds, the same holding in your IRA, no cost to you, no taxes to you because it was just a rollover, but now you have money in an IRA that you can do your transfers from, okay? Just understand that if you still have money in the 403B, you have a required distribution from the 403B and you have a required distribution from the IRA, but they're based on the values of the two accounts. So you've still reduced that down. Those are the, and then the 70 and a half, warning on 70 and a half, they mean 70 and a half. So my birthday is February 25th. When will I be 70 and a half? Well, not until October 25th. Then I'll be 70 and a half. Okay, after I hit 70 and a half, then I can do these distributions. And then I can do them for the rest of my life because I'll be past 70 and a half, but don't do it ahead of time. People get confused. They're going, well, I'm going to turn 70 and a half this year, so they said I have to take a distribution. I'd like to do it in January when the market's up, so I'm going to transfer that to charity. Well, they weren't 70 and a half, so it's going to get taxed. It'll be a deduction to them, but only if they itemize. So they've kind of destroyed it in there. So you can't go wrong with qualified charitable deductions. That's my sales point. Why does this work? We talked about it. No income exclusion means no tax. Adjusted gross income is lower. That means Social Security might not get taxed or taxed as much. Until you pass $45,000 with Social Security, you haven't maxed out the point that they're going to tax. It may increase an includable medical deduction, and it reduces reportable income even when you're not itemizing, and that's the key, that you can still get your income down. Are there still some credits left for us? The good news is yes, but they're pretty exotic. Okay, we used to get a credit for what? For the furnace. That's gone. We thought we got a credit for efficient appliances. That was never us. That was the manufacturer got those. We got credits for purchasing a car. Those are gone. There are still credits for purchasing a hybrid or an electrical vehicle, but here's the bad news. I don't think there's any hybrids left on the list. They all sold through. When they sold their 60,000th car, there was no more credit. The electric cars are new enough that so many companies now creating electric cars, that credit still exists. The other credit that still exists is called the residential energy credit, and I'll break that down. It's just two things. It's either solar or it's geothermal. So you're either getting your electricity provided by solar cells, which have to create a certain level for you to get the credit, or you've done geothermal. Those still work. So here's the credit. Solar and geothermal is 30% of the equipment cost. To put a geothermal in the city of Madison, 2 years ago, the last time I looked at pricing on it was already at $27,000. So I'm sure it's gone up a little bit since then with its popularity. But 30% of that is a $9,000 credit. And a $9,000 credit can chew up your taxes for a number of years, because if you can't use it all, you get to carry it forward. Solar is kind of the same thing, but there it's exotic. You have to have, you're capped at $1,000 per kilowatt. So if your solar system is creating 4.5 kilowatts out there, you get $1,000 per kilowatt that you're creating. So you get about a $4,500 credit out there. It's not against what it costs to put it in, but what it creates. And one more, the electric and hybrid vehicles. The electric vehicles are $7,500, and there are still some left out there. And the one is the one I use as an example. This is your golden justification for buying a Tesla. Okay. The Secure Act. How many people have heard of the Secure Act? Just a handful, okay. Here's the news on the Secure Act. This will be impactful if they get it passed. When I did this slide, it had already passed the House, and it was streamlined. It was going to go through Senate. Senate just had to agree, had to get their version to agree with House, and then it would be passed. Okay, and we were positive it was going to be passed by the end of the year. Without naming names, there's some problems currently brewing in the Senate, okay? And we don't know if it'll actually get through or not. But the theory is that they still want to get this through by the end of the year. And Senate's got a bill out there. They just have to fine tune it through their committee to get it to match up with the House, and then it'll be passed. But this is what the Security Act does, or the Secure Act. The required minimum distribution we just preached was 70.5. The House's version moves that to 72. The Senate's version moves it to 75, but they bump it up a year at a time until it hits 75. What does that mean? Well, it means that you can sit on your IRAs for at least another year and a half, potentially up to 4 or 5 years that you can sit on your IRAs and let them grow. Now, no one's going to let you do that without payback, right? Because I just preached to you about why they want you to pull money from your IRAs. Well, there's no more 70.5 requirement for contributions in either. So if you're still working, if you still have earned income from anything, and you're over the age of 70.5, in the past, you couldn't put money into your IRA, and you, in fact, had to be drawing it out. Well, now they said you can keep putting money into your IRA until the day you die, as long as you have enough earned income to cover what you're putting in, up to the limits, which is still around $6,000. Okay, and then no age restriction on contributions. So you can keep doing that right up. I had clients who were 85 years old, and they would not leave the university because they still got a parking spot. That's why they were still working. And they were making, $8,000, $9,000 as emeritus, and that was earned income, and they could continue now to put money into an IRA. Back then, they couldn't. 70.5, they were done. They couldn't keep putting it in. Where's the payback? No more stretch IRA. How many people understand a stretch IRA? A lot more than the people who knew about the Secure Act, right? Stretch IRA says that if you've lived your life right and you've built up a nice portfolio, You were living nice and cleanly off of the money that you'd already paid taxes on. Your Roth, your joint account, your banking account, your bonds. But you weren't touching your IRA. You were just leaving it out there. And when you turn 70 and have to say, well, you got to take a minimum distribution, and that's exactly what you took. You took the minimum. They said you had to take $4,372. You didn't take $4,373. You took $4,372. And the IRA kept building and building. And when those people passed away, who got that? Generally, first, the spouse. Okay, and the spouse was told, well, you can keep delaying it too. Just call it your own and just say, I don't want to take anything more than I have to take from it. And eventually, the kids got it. Okay, and the kids could stretch it out over their lifetime if they wanted to. Now, you're all very intelligent people in this room. So you've trained your children well to know that when they inherit the IRA from you, they're going to take the minimum distribution and that's it. They're not going to become spendthrifts and go out and buy Teslas, right? They're going to sit on that IRA. That's called a stretch. That IRA could be stretched over the person, over, in my case, over my life, then over my wife's life, and then when she died, over my two daughters' lives. And when they died, it could be handed off, as long as there was still IRA in there, could be handed off to my grandchildren. And my grandchildren, they were the first ones that had to take it fast. They had to take it as fast as their mother or father, whoever had owned the IRA at the end. They had to take it that fast. But that was a 3-generation stretch. The government says, no more. The House says 10 years, and you have to get it all out. The Senate is wavering over how long it'll take. I think that it'll settle in at 10 years. So now when I die and my IRA is passed through to my two daughters, within 10 years, they're going to have to drain that IRA. So let's say that I give them $400,000 of IRA each. Okay, in the course of 10 years, they got to take $40,000 a year out of there. Can you see what that'll do to their tax returns when they're still working? That's when the IRA is going to pay the money back to Congress that they need. So it's going to happen. If they don't get it done by December, watch them pass it in January and tell you it's retroactive, right? If you are over age 70 and a half and you're already drawing on your IRA, you're grandfathered in. So your IRA follows the old rules, at least until they stop that from going forward. But anybody from 2020 on is going to have no more stretch. By the way, it includes Roth IRAs, but the good news is Roth IRAs aren't taxable. It just means they can't sit on them anymore. They got to distribute them out. Okay, so my Roth IRAs to my daughters, they'll have 10 years to get them out of there. They won't pay any tax on the money coming out, but they won't get to let it build tax-free. That takes me up to tariffs and treaties, and I've got about 10 minutes before I'd like to take a break at 11. Well, I'm going to take a break in about 5 minutes, give you a 10-minute break, and then have you come back and we'll wrap up the back half of this. What I'm going to do is open it up. Are there any questions right now about the stuff that I have covered?
2 quick questions. What date is the grandfathered in for the IRAs?
It's going to be, if they pass it in 2019, it's active for January 1, 2020. So anything before January 1 of 2020. That would mean that they had, for instance, let's say that I had inherited an IRA from my father. I could still continue to stretch that one out. But when I died and it went to my daughters, they wouldn't get that because they were getting it after 2020. So it's when you actually inherited it.
And then the other question on the donor advised funds, is that you get the deduction, no minimum, no max, no cap?
Right. At this point in time, yes, oh, I'm sorry. At this point in time, there is no cap on the donor advised fund. So when you do a donor advised fund, if you want to put $30,000 in there or $100,000 in there, it doesn't matter. And it does not have to come out of the fund all at once. What a donor advised fund is in the past, we had people would come in and they would create a charitable trust. And then they'd put their money into the charitable trust. They'd get the deduction, but they didn't have to spend the money out of there yet. All right? Now, again, not picking, but there was a huge charitable trust that was running out there in the state of New York that just got shut down because they were taking the donations for all the money that went into that charitable trust, but they got caught using it for personal purposes. Okay? With a donor-advised fund, you don't have control over it at all anymore. With the charitable trust, I at least was the executor. I could pay out what I wanted to pay out. I just had to follow the rules or not get caught. In the case of donor-advised funds, I don't control those outflows. That's up to the custodian and the donor-advised fund. All I control is the when. I tell them where it's got to go out. If I told them it's got to go out to this individual, they'd come back to me and say, can't do that, that's not a charity. So there's control on them.
Did I hear you say about donor-advised funds that I can deduct from my taxes any contributions that I tell the donor-advised fund to do on my fund's behalf?
The question is, when do I get the deduction? I get the deduction when the money goes in. Okay, so if you put $20,000 into the donor-advised fund and it just sat there, you never even sent any of it out at the end of the year, you'd still get a deduction for the $20,000.
Yeah, in the year that I made that.
In the year that you make the contribution in.
Are there any benefits for me if I distribute money in later years so that donor-advised?
There's no benefit then in the question is in the later years, is there going to be benefit? So in other words, let's stretch my example out. I put $40,000 into a donor-advised fund and I take a $40,000 deduction. Now, over the course of the next 10 years, I donate out $4,000 a year. When I donate out the money, when I tell donor-advised fund, go pay this charity that I picked, I don't get anything for that. Okay. The other thing with a donor-advised fund is because it's a charitable trust, you're not paying taxes on the dividends that it earns. You're not paying taxes on the capital gains that it appreciates. Okay. You're also not taking losses. I had people come in the first years when they did donor-advised funds, they came in and said, well, my fund went down. I'm going, it's interesting, but you gave the money away. That's not your involvement anymore. Your involvement is just to get to control where it's going out. Good questions. Any other ones? Okay, I must have educated you really well. Either that or you're very good seventh graders. Take about a 10-minute break, but now remember, you're seventh graders. That doesn't mean you can go outside and play and you got to be back. No lunch, all right? So I'll see you back here in 10 minutes.
There'll be time for questions after the presentation as well.
Wow. I had lots of questions, and they were all good questions. There was a theme, a common theme. I didn't forget to talk about it. I chose to not talk about it. So I'm going to just mention it briefly because it gets complicated, right? It involves two things. I had all kinds of people who came up, and they're turning 70 and a half this year. And they're going, now what? Okay, well, the Secure Act does not exist. Even if they passed it today, it doesn't take effect till 2020. Okay, you follow that so far, right? Here comes the complication. Your RMD for this year, because you turned 70 and a half, or whatever age you are, is not based on your 2019 value of your IRA. It's based on the 2018 value of any retirement, any deferred account as of 12/31 of that previous year. So if you put that together, somebody says, well, I'm turning 70 and a half this year, and all my money is in my 403B, but I really want to take advantage of this charitable contribution. So I'm going to roll my 403B into an IRA, and then I'll transfer my required minimum distribution to my charity. It will not work. So here's what's going to happen. When you roll the 403B to the IRA, the 403B already knew what your required minimum distribution was as of 12/31/2018, and guess what? They won't roll all the money over to the IRA. They're going to cut you a check for your required minimum distribution, and you can't do anything about that. That's taxable. So what I tell people is if you're really trying to do this, and this is the year you're turning 70 and a half, and you're trying to monkey with that rollover to an IRA, you need to roll it over to the IRA before the end of the year. You're going to get your required minimum distribution and you're done. Then in 2020 is when you start transferring money from the IRA, but not before, because it won't work. In the example that I gave you, I have $100,000 in my 403B, so on November 30th, I roll it over to an IRA, and then I take my $4,000 required minimum distribution that I had calculated on my own because I was so smart, and I transfer it to a church. Here's what happened. When they rolled the $100,000 over to the IRA, they already cut out the $4,000 and gave it to you. That's taxable, okay? And now you took $4,000 from the IRA and transferred it to a charity. Well, that's not taxable because you used that charitable distribution rule, but you didn't get out of the $4,000 that came out of the 403B, okay? All you did was reduce your IRA balance before December 31st of 2019, so that in 2020, your required minimum distribution is a little bit lower. That's all you accomplished. So you might want to do that transfer and then next year start the process. Here was the other question. So I'm 71 now, and I took my distribution for the year, and next year they passed the Secure Act, and it says I don't have to take a distribution, let's use 70, I don't have to take a distribution until I'm 72, so do I get to skip a year? I have no idea. The reason I have no idea is that it'll depend on the way Congress writes the language. Okay, first off, what year do they, or what age do they pick, and then number two, are they thorough enough to write all that in there? How many people right now looking at Congress thinking that they will be thorough enough to write in what happens if I'm 71? I don't think they will. IRS will come back on them going, what the heck are we supposed to do? Okay, you didn't give us any direction. And that's what happens. In January of 2019, we got a Reconciliation Act which cleaned up mistakes that they had made in the 2018 writing of the law. And then in August, just a couple months ago, we got another reconciliation. These come out of the committee, they don't come out of Congress. What happens is IRS goes back to the committee and says, okay guys, we understand what you're trying to do here, but you didn't say it. So you better, if you really meant that, you got to say it. So then the committee wrangles with that and they say, yeah, that's what Congress really meant. So we'll write that and we'll hand it as a memo over to the IRS, and the IRS says in an announcement to all of us, and you all read those IRS announcements in the middle of the year, right? Announcement in the middle of the year notifies us that, oh, this is what Congress really meant. Here was the problem. In 2018, all these businesses figured they were going to get that 20% deduction because they were a small business. So they were trying to take that, but in the meantime, they were also very responsible, so they put money into their health insurance, they paid it through their business, and they put money into their retirement. And then in January, late January, Congress came out and said, oh, we forgot to tell you, you got to subtract all those off before you figure your 20%. Okay, I'll take me as an example. I didn't make that much self-employed. I made some money doing these things, not from here, okay? I don't want you guys to think that you had to pay. But the teaching that I do, I get paid for. So I had some self-employment income. Well, I deducted all my health insurance premiums that I pay, and then I put whatever was left, I put it in an IRA, because I was going to be responsible. I didn't want to pay taxes on that money. I was thinking I was going to get a 20% of my $20,000 as a deduction. I wound up with nothing, okay, which meant I had $4,000 more income on my tax return, which meant I had to tell my wife, yeah, we owe an extra $1,200. There went my Christmas gift, okay? She made me take it back. So anyway, the bottom line is Congress can change this thing. So we don't really know how they'll write those final rules. My suspicion is that you may get to skip a year and then catch up when you get up to the age that they're at. Yep.
Is there quite a wide range of expenses when you have a donor advance fund? Whoever controls that?
Okay, are there a lot of expenses when you have a donor-advised fund? It's going to depend on the funds that you use. So my advice always when you're doing investments, you have an upfront cost. If you're going into a donor-advised fund, into a fund that's being handled by an investment planner, that investment planner is going to get paid. So let's say that you're paying 2% to invest. You also need to look at the prospectus from that company and find out what are their internal costs. The internal costs on a mutual fund are derived from the fact that they have to trade. They're making trades inside there. Well, if I'm in a dividend-producing fund, they don't trade very often because they hang on to stocks forever. They let them go up in value and you get your dividends, and that was the nature of the fund. But if I'm in a growth-style fund, they're going to be trading all the time. And every time they make a trade, it didn't cost you money, it cost them money, and that is reflected in a little bit less of the percent of gain coming back to you. So the bottom line is with a donor-advised fund, I will advise you to make sure you look at the fund prospectus and find out what are their internal costs. So if I look at Fidelity and I look at Vanguard and I look at American funds and then maybe I look at, I don't know, T. Rowe Price, just to throw 4 out there, they're all going to have different internal funds based on how they invest. So yeah, so that's your control by picking the one that you like best. Also, always, when you look at internal costs, look at overtime performance and look at how they're placing your money. If I'm in a donor-advised fund, I probably want funds that are fairly conservative and I want them paying dividends because that I'm going to get use out of those dividends going forward to increase my charitable giving. Not my deduction, just my charitable giving. Okay, great questions. So tariffs and treaties, let's have a little bit of fun. A tariff is an import, it's an import duty, that's what it's called. But don't be misled by that. It is a tax. It's paid by the importer, okay, on certain goods. It's imposed on a specific country, it can be imposed on a specific import, and it can be calculated, or it is calculated as a percentage. So in late fall, that's amazing. It's late fall now, isn't it? It's just hard to imagine that when you walk outside. In the late summer, I guess I will say, we had all these tariffs that were being levied and talked about. Some of them never took place. Some of them did, so it just really depends. But they were levied on a particular country or countries, China being the biggest one, okay? So we levied tariffs on China. That tariff was levied against the country, but then it was defined as on what products. Whether we levied tariffs on Mexico, we levied tariffs on Canada. On Canada, it was on farm crops and on timber, and timber was the big one. If you were building a house during the summer, you saw the cost of your materials went up by about 20%. And that was because of those tariffs that were out there. So it's levied against a country, it's levied on a line of products or goods or services, and then it's calculated as a percentage. So not a dollar amount, but a percentage. Who really pays the tariff? Well, not the targeted country. That's the misnomer. The country doesn't pay the tariff. One of 3 entities ultimately pays the tariff, and in most cases, it's going to be a combination of the 3. The first one being the importer. So whatever company is importing those goods into the U.S. for another company or in general to then distribute to companies that are going to buy from them, the importer gets hit for the tariff. They pay it, comes out as a duty, and that does go to the government. The government gets that money. The importing company may eat that cost or pass some of it along to the consumer. Now, the consumer for the importer is the company that they imported the goods for. So the big one, what was the number one that we were throwing the big tariff on? Steel. Okay, that was the biggest one. It was on steel. Well, who buys steel from China? Lots of people. Amana, when they build your appliances, Frigidaire, The White Corporation, which makes a lot of bicycle parts, they were buying steel from China, bringing it into the U.S., manufacturing whatever they were going to manufacture. So the product was manufactured in the U.S., but it was made out of a product that came from another country. Okay, now they had this choice. The importer turned to them and said, well, you know, that steel used to cost X, now it costs X plus 15%, or X plus 20, or X plus 25%, depending on the day, all right? We're not going to eat that cost, so you got to pay it. So the steel that used to cost this now costs this. What does that company do with that cost? Well, they get to eat it and say, okay, I guess we just don't make as much profit this year, or they do what? They pass it on to you, okay? Now, we're going to talk about what happens at each of those entity levels when they do that. So the consumer, you may pay directly in higher costs, or indirectly through general inflation, because all prices kind of went up, so there's an inflation effect as well. I had a friend who was building a house. He needed to buy a jointer because he does all his own cabinet work. He was telling me, he was bemoaning to me that he had ordered this jointer from a US company, but it's made out of steel, which they import from China. He ordered it at one price, and when it was delivered to him, it was 25% more. And for him, that was $700 on that piece of equipment. Okay, so it's a real tax, is what it felt like to him. So that's how that's being passed on through. So who really benefits? Because otherwise, if no one benefits, why would we do them, right? The imposing country increases their tax revenue. So yes, when the US said we're getting $325 billion from China, that was sort of true. We were getting $325 billion, it wasn't coming from China, it was coming from these importers that are paying the duty now when it comes into the country. Okay, the industry targeted may benefit, so the consumer now buys domestic instead of foreign. So now we're not talking about someone who uses the product to manufacture something, but an actual manufactured product. So you have the choice of buying a Kia, or you can have a Ford Taurus. Probably a bad example because I think the Ford Taurus is made overseas, but you get my drift, right? I can buy a domestic car, or I can buy a foreign car. But the foreign car that I'm going to buy is coming from that has a tariff levied on it. Because it has a tariff levied on it, they raise the price of that vehicle, because they're going to pay that when it's imported into the US, to the point where my US car is now cheaper. So I buy the US car because all that mattered to me was not comfort or anything else. It was just about the money. So I buy the US car instead of the foreign car. I've just helped that industry by imposing that tariff that created that higher price for the foreign good. The next one in there, it says the corporate tax collections increase, because now I'm buying from a US company that's paying US taxes. So that money that I paid for the car is now being taxed in the US. And then it may create additional employment within the targeted industry. So we hired a bunch more workers in the plant in Janesville to make that car because there was more demand for it now that the foreign car was getting too expensive. So that's the benefit side of things. Fairly easy to follow that down through. Are there adverse consequences? How many people in here believe that you get something for free? My hardest part in SCORE, when they call and they say, oh, you know, I read about SCORE and it sounds really good and I'd love to have a mentor, but how much is this going to cost me when our services are free? And they go, yeah, okay, but how do I wind up paying for it? Because we in America, we've been trained that nothing's free. You always got to pay for it somewhere. Well, tariffs are the same way. So I just showed you how the companies benefited from that tariff. Now let's look at the adverse conditions. Tariffs are inflationary. So by driving up the price of Chinese goods, making us buy domestic goods at higher prices, because they can command those prices now that we got the competition out of the way, then we have general inflation. Everything kind of went up by that amount. We're feeling that a lot in the industry, in anything that's dealing with lumber and the foodstuffs. Okay, tax on the economy. Higher prices cause consumer to put off purchases. So in essence, with higher tariffs, if it's a discretionary item, we may not do it. So our church is deciding whether we're going to put carpeting in the community room or not. And we got our quote, and our quote was $16,000 on up to $25,000. We're going to take the one in the middle because that's what all smart consumers do, right? So we're going to take the $20,000 one, but that's discretionary. I mean, I can't see the concrete floor. The carpeting's still pretty good. So as treasurer, if I don't want to spend $20,000, well, I won't. Apply this argument to something that you were going to buy that now went up by 15 to 25% in cost. If it was discretionary, are you still going to buy it? If the answer is, I might not, that's a direct impact on the economy because that money was never then spent. Layoffs may be an indirect result. So because I then didn't buy the product, that company didn't have enough work, so they laid off some employees. So here we are, one industry is hiring on because of the tariffs, another industry is laying off because of the tariffs. So you got both sides of the coin. Increased cost of the company results in lower profits. This one no one likes. They're going like, how come dividends were cut on stocks? Well, probably because the company didn't want to pass their cost along to the consumer. They wanted to stay competitive. So instead, they ate that, which meant they reduced their profits. And what are dividends based on? The profits of the company. So all of a sudden, those dividends aren't there. What else could go away with dividends? If the dividends are down, guess what? I might not buy the stock. And if I don't have demand for the stock, what happens to the value of the stock? It drops in price. So for every action, there's an equal and opposite reaction. The issue is whether it benefits you personally or not depends on what side of that coin you're on. Okay? If I had a discretionary item and I didn't buy it, I didn't get hurt by the tariff. It didn't bother me at all. But if I was working in the industry, it might have bothered me. If I had to buy that item, it certainly could have bothered me. So let's look at an example. 15% tariff on imported steel forces a company to switch purchasing to a U.S. steel manufacturer. So at 15%, they decide, to heck with it, I will buy U.S. steel. The steel was X dollars per ton, but it is now X dollars plus 15%. Purchasing company was an appliance manufacturer. They needed the steel for the production of the appliances that they were making. The steel they purchased to manufacture the appliance now costs more. Cost is passed through to the consumer because they didn't have a lot of shave. They were in a competitive market to begin with, so they said, well, my prices went up by 15%, or my costs went up by 15%, so will my prices. Okay? So their prices went up. The consumer decides against purchasing that new appliance. That's not a good thing. The appliance company now profits suffer, and they in turn order less steel as the demand drops. So the very industry that we were helping, we might have also hurt. Okay? So the bottom line with tariffs, they are a tax. Are they beneficial? Sure, they have benefits. They need to be, if you think of them as an axe, okay, what can I do with an axe? I can chop wood to put in my fireplace to warm my house, and I'll feel cozy and warm and be romantic with my wife. Okay, what else can I do with an axe? I can cut down a tree, okay? That might be good, that might be bad because the tree was producing oxygen, now it's gone, okay? It was creating a beautiful view and it's gone. So it could be good, could be bad. I still got wood out of it, the lumber went into a house, built a nice beautiful house next to me, and that was great. What else can I do with an axe? I hate to say this, but I could kill my neighbor with an axe, right? So it's who's using the axe and how are they using it? Tariffs are an axe. Okay, that's exactly what they are. If we use them carefully, they will protect certain industries. If we use them carefully, they will not let inflation get away. If we use them carefully, we will bring trade back to the U.S. that needs to be in the U.S., and along with it, we'll bring revenues back. What we don't want is to get in a war where we're using the axe to kill a country. That's where we got to be careful. Question?
Now, cooking steel is a dirty business, environmentally. So that means if we make the steel ourselves, we have the pollution and so forth, which before the Chinese did.
Right. The question down here, or it's not question but statement, and I agree with it, is that if we're coking steel here in the U.S., the pollution that was over in China is now here. Okay? I'm going to say my next words carefully because some people will agree with them and some people won't. Is industry in the U.S. more proactive towards the eventual climate change because of that than other countries are? I think the answer is yes, but are we encouraging them or are we giving them a free pass? That's the question. We have to be very careful that when we switch everything over to our industries here, in the process of protecting that industry, we can't lose sight of what else we need to protect, which is the environment. We have to be careful about what are the other impacts. What I like about that statement is that's exactly it. I didn't put it in there, but there are environmental concerns when we do a tariff. We can take one problem and that was away from us and bring it in here. So we got to look at all the aspects of it. But that's your example of how a tariff might work. Now, who got benefited out of that whole tariff? Well, the U.S. steelmaker did. They can put more jobs in. They can increase their price now because their competition was pushed back a little bit. So they've got room for growth. So how does it impact stock markets? Inflation, economic slowdown, or / recession, and global impact. Those are the three impacts of these tariffs on the stock market. So let's look at each one. Inflation says higher prices create inflationary periods. Nobody likes inflation. None of us do. But if we keep raising prices, well, then we have inflation. Well, inflation's okay as long as we do what? Continue to increase our wages. How many people in here are still getting a paycheck from an employer? A couple, okay? The rest of us are getting it from where? Social Security and our pension. So inflation went up. Which one of those will be raised for the cost of inflation? Social Security. Will it get the full impact of inflation? No. It gets, in fact, Social Security took a whole bunch of things out of the inflation basket and said, yeah, we can't count that, we can't count that. Why? Because they're kind of inflationary items in there that would drive the cost of Social Security up to the point where we could collapse the system. So that's a balance in there. Will your pension go up based on inflation? The answer is no. Your pension, if you're on a state pension in here, how many people are on state pension in here? I always know that that's the majority of my crowd. God love you, I am as well. What will put my state pension up? Not inflation, the stock market. Performance in the stock market will create an increase in my pension, just as a decrease, a bad market could actually cost me a little bit. Economic slowdown, recession, the economy depends on a balance between supply and demand. We disrupt that supply and demand when we put a tariff in. It may be a temporary one until the market rebalances itself. It could be a permanent one if we're putting that wedge in where we can't replace it on the US side anyway. So now we just created inflation that's going to impact us. Higher prices or lagging wages create constriction in demand. That's a given. How many people are happy about the wheel tax? Really, no one's happy? How many people are happy about the potential of raising the gas tax? Again, I don't see any hands. You're amazingly smart. Okay, oh, there's a couple up. All right, now, why do I not like that raise in tax? Because it costs me more at the pump, and everybody has that internal bias of going, if you have the chance to pay less, you'll take it. If you are given the option to pay more, very seldom do we unless we get something else for paying more. What do we get out of an increased wheel tax and an increased gas tax? What do we get? Better roads, okay? Because that's where that money's going, is to pay for those roads, okay? What else? It's an indirect effect. If gas goes from, when I was first driving, it went from $1 to about $2, okay? Then it went from $2, do you remember when we got all the way up to $4 a gallon? What did we all do when it got to $4 a gallon? We used it less, but if we had to use it, what did we do? We put a demand out there for cars that got better mileage, okay? And did the U.S. automakers comply with that? The answer is yes. I remember in the 70s driving cars so small that my knees hurt, right? But I was getting good gas mileage. Okay, as you drive home today, I want you to take a look at what passes you on the road. Do you think it's going to be more sedans and compact cars or more SUVs? SUVs. Why? Because the cost of gas went down, and the auto industry said, hey, we can't sell these compact cars anymore, we'll sell SUVs. Are they making the mileage better? Yeah, okay. So one of the offshoots of raising gas tax will make the industry give us more fuel-efficient vehicles. Ultimately, though, let's go back to those that said, no, I don't want to pay more gas tax and I don't want to pay a wheel tax. All right, how do you avoid the wheel tax? Don't tell me take the wheels off your car, but you just stop driving a car, right? You go to Uber or whoever else, use mass transit. Well, that's good for the environment, it's great for us. But the money that they were going to raise for the wheel tax, did they ever get it? No, because we starved it off. So they raise gas taxes and say, well, this will go to build the roads. Who pays the gas tax? Only those people who have to drive. How many people in here, if gas suddenly jumped to $4 plus a gallon, would curtail their next travel? I think you would. You'd at least drive, you wouldn't go as far away. I may not go and visit my brother for Thanksgiving and use the excuse, I don't want to pay the gas tax. So when we have inflation, when we do those sorts of things, when we try to raise funds, revenue that way, what happens is if it's discretionary, we stop using it and we get a negative effect. It's called a regressionary tax. How many people would love to see them tax Social Security without limit? Not tax the Social Security you earn, but tax you on your wages they charge Social Security tax, FICA tax, on all the wages. Yeah, right now they stop at, you know what the number is? 120 some thousand, 123, I think, 123,000. After 123,000, you no longer pay FICA tax. So some basketball player the other day signed a contract for what, $3.5 million a year? They're going to pay Social Security taxes on 120,000. All the rest of it is tax-free, not income tax, Social Security tax-free. So let's say that we just charge that tax on all the way up. What do you think that person who earned $3.5 million and paid Social Security taxes on $3.5 million is going to want to earn from Social Security when they retire? They aren't going to settle for $40,000, okay? So it's a push-shove game. It's a push-shove game, and generally the Congress will say it's always a sum-zero game. So how much does it impact the stock markets? The global impact, tariffs can directly impact global markets. That's what we always want to ignore. So we issue a tariff on China. Chinese companies wind up getting punished for that. That impacts the Chinese stock market. It also impacts the money that China is now investing in other companies or other countries, and what we get is a global impact. We can't ignore the fact that we live in a global world. How many people have traveled outside of the US in the last 2 years? There you go, okay? We are a global economy. We don't stay home. And then the treaties. Treaties are designed to promote, that's the end of the sentence, they're designed to promote, that's what a treaty does. So security against global unrest, that's the first reason for a treaty. So examples, the Iran nuclear treaty and NATO are treaties that we sign to protect us. Economic and expansive directives, that's NAFTA, the North American Free Trade, which is now renamed. It's the Mexican or the, I can't remember the name yet, but it's the Mexico-US-Canadian that's been replaced. But that treaty is protect trade between those countries, which protects economies. And then world policy. The Paris Accord was a world policy. It wasn't protecting us from something, it was a policy that we wanted the world to follow. Direct impact. Fear of global unrest causes investors to become protective. When you're protective, you are not going to invest in the stock market because that's not protective. You're going to invest in cash, gold, commodities, places where you think that your money is going to stay stable. Bonds is a big example, but it's pulled out of the stock market. Global conflicts left unresolved disrupt supply chains. So examples would be Mideast oil, general delivery routes for imported goods, Gulf of Hormuz and Suez Strait is a direct example of that. If we don't have treaties to protect that in there, then those regions become unstable, and then that impacts global positioning and results. So how do they impact stock markets? The indirect impact, global policy treaties incentivize certain industries, all right? My example, the Paris Accord was a boom to environmental companies. When the world signed the Paris Agreement, we were basically saying, we acknowledge climate change, we acknowledge that we as human beings have something to do with it, and we are going to, as countries, try to act responsibly to reverse that process. Well, how's the only way we're going to reverse that process? So we're going to stop using coal and we're going to go to solar. Okay, we're going to reduce emissions from cars. We're going to reduce emissions from factories. We're going to get better mileage from our vehicles. All those things will impact our environment in a positive way, but companies manufacture all those products. So the Paris Treaty is a boom to all those companies that are in that field. If we take that away, we take away that incentive. Now they're struggling with their competitors again. Brexit impacts British and European economies. Brexit has been now extended so many times that we don't know if it's ever going to happen, all right? They've lost prime ministers over it. They've had ugly fights over it. The problem is that Europe will not let England go without some kind of an agreement. If they don't have an agreement, the currency is going to be so impacted by it. Will that impact us? Yes. We invest in a lot of English companies or British companies. They'll be impacted by that. That's a ripple effect that comes through the entire industry. Advice for the investor, here it is. Pay close attention to the issues. They matter. They really matter. Don't let anybody tell you that they don't. Okay? Keep your portfolio balanced. And by balanced, I mean, don't go all domestic right now because you think that's the place to go. Keep it balanced between domestic and global because it swings back and forth all the time. Growth versus value style. Growth says I'm investing in companies that don't pay dividends, they just grow in stature, which means their stock prices go up. Value says I invest in companies that give me their profits back in the form of dividends. If I have both in my portfolio, okay, in a bad market, growth will suffer, but value is still paying dividends to me, and those dividends are buying more stock cheaper. If the economy goes up, if the stock market goes up with it, well, my growth funds are going to do really well. Okay, my value funds might be a little stodgy, but they're still paying dividends too. So you want to balance in your portfolio. Short-term versus long-term investing. There is a definition. Short-term investing says if you know you need the money within the next 7 years, that's short-term, period. You should be protective with that kind of money. If you don't think you're going to use it for more than 7 years, then you can go lean more towards the growth side of things. Income versus growth. So it goes right back up to that growth and value. Expansions versus recessionary holdings. There are holdings called sin taxes that do well in recessions. Think about it. When the market gets really sour and the economy goes south, what do we not stop doing? Drinking. In fact, we drink more, we smoke more, we eat more. We indulge when we really ought to be staying home. And the reason we do that is because human nature says, I'm turning on TV and the news is depressing. I look at my stock portfolio and the news is depressing. I look to the world markets and it looks depressing. So what do? Go out to a nice restaurant, reward myself, and drink. When I get home that night, I feel better. Okay? In the morning, I won't, but it's okay because that's in the morning. Recessionary stocks are called sin stocks, and those recessionary stocks. So along with the products in that area, products in the entertaining area, sporting goods do really well in recessions because we don't stop biking. We go out and we do more exercise to make ourselves feel better. So those are recessionary stocks. Think globally, act locally. Vote for candidates who consider the longer, bigger picture, not how long they can stay in office. Okay? I am not judging. There is plenty to go around on both sides of the aisle. But I'm tired of politicians who only worry about how they'll stay in office all the while saying they're representing the needs of the people that they were voted in by. I question that. If they're not brave enough to look at the long picture and come up with some strategic planning for that, if they're willing to put their career on the line to fight for a cause, if that's your cause, that's where your vote needs to go. So pay attention to those sorts of things in there. Ideal portfolio, don't think of this as equal thirds. That was my daughter. My daughter said, well, what size should I make them going? It's not about size. Up there, I've got one third of my portfolio is dealing with growth and income later. Another third is dealing with protection or income now. And another piece of it is dealing with conservative exposure because it's going to be income next. If I don't have a really large portfolio, where might all my money be? Not in 3 parts, but only in 2. Because I've got income that I need now and I'm pulling it from the market, and I got income that I'm going to need when that pool runs out. In the conservative bucket, that protection, I should be in bonds, I should be in cash, money markets, go get the best rate you can wherever you can get it. Interest rates are falling again, so it's hard. But that you have to be patient, because that's the money you're using now. The money I'm going to use next, dividend-paying stocks, a little bit of value stocks, balanced funds, so kind of a mix between bonds and stocks. But again, don't get it so far out that the market going south bothers you. Markets go through 5-year cycles and 10-year cycles and 20-year cycles. The 5-year cycle should be ignored. Okay, basically what we tell people is you raise tariffs and you have a bad market for a week or 2 or maybe a month or 2. Okay, it'll recover. As soon as that all settles down and balances out, they'll recover. The longer periods are 10-year periods. If you slice the market into 10-year periods, I think there's one 10-year period now, which occurred right around 2009 was in there, where there was actually a negative return from the market. Otherwise, all 10-year returns have been positive. But I can't leave money in the market for 10 years unless I don't need it for 10 years. So I got to be cautious with that. And then I said long cycles, those are the 20-year cycles. How long has the bull market been running? A long time. Okay, we had a dip, we had our recession in 2008 and 9, but now we've been on the other side of that for going on 11 years. Okay, can we continue? They're saying that within a 20-year period, in a 20-year period of the market, you are going to have a tough spell in there someplace because things have to reset. If you can position your portfolio, you can weather that. You can get around it and not have it take you down. Last topic, annuities. With annuities, I just want to demystify them. There are 2 kinds of annuities. There are fixed annuities and there are variable annuities. Those of you that said you were on the state pension, that is a form of, for most of you in here, I'm going to bet, a fixed annuity because you're in the fixed annuity. Some of you probably were big risk takers, and when you came out, you might have left your money in the state retirement system in the variable side, and you could have anywhere from 50 to 60% of it in the variable side, depending on how you did, how long you worked, how things went. Okay, a fixed says that you have a fixed rate of return over a fixed period of time, and that's guaranteed, okay? A variable says you're investing in the market, so your annuity value could fluctuate up or down depending on what the market does. So they're 2 completely different animals, and people always think the word annuity says they're all the same. They're not. So we'll look at fixed annuities first. You have a fixed interest rate. Now I'm not talking about the pension that you get from the state. I'm talking about one that you go out and purchase because you want additional income or you want additional protection. The 2 reasons for buying an annuity. One is because one day I want it to create income for me and I don't want to take the risk that I choose a bad time to turn it on. Or number 2, that I got money that I don't want to pay taxes on the growth of it and I just soon kind of put it away and maybe someone other than me is going to wind up using it. That's the 2 purposes for annuities. Now I get to choose. If I'm real conservative, I'll take a fixed. If I'm a little bit more risky, I'll take a variable. So I've got a fixed interest rate. There's no market style investing in it. Example of a fixed annuity right now, a 5-year fixed annuity, I think you can still get 3.8%. Okay, and that's been coming down. It was 4% in the middle of the summer on a 5-year annuity. Those are now coming down. But with a 5-year annuity paying 3.8%, you've made several promises. Number one, you will leave the money in there, no questions asked, for 5 years. You're not going to ask for it back. You have accepted, no negotiation possible, 3.8%. So if in year 3, inflation has caused interest rates to go up to 5%, you can't go to the insurance company and say, hey, you know, that 3.8 was good 3 years ago, but now I'd like 5. They're going, no, you're locked in for 5. You agreed to those terms. Okay, and then the third one is a gift from the annuity company and the IRS and says, all the growth that's in it, you don't have to pay taxes now. But when you take the money out, you will pay taxes first. Okay, all the money coming out will be taxed. Stated term, the interest is guaranteed for the term of the annuity. You can buy 3, 5, 7, and 10-year annuities. You can get 1 and 2-year fixed annuities, but the interest rate's so low that I question why you're in it. You might as well go to something like an online bank or a money market someplace. Annuity company levies the penalty for early withdrawal. So if you break the 5-year promise, they're going to get to keep some of the money. And money can be withdrawn at the end of the term period. So at the end of the term period, at the end of 5 years, doesn't matter how old you are, doesn't matter what the promises are, at the end of 5 years, that was your term, you can take the money and go. When you take the money, you'll pay taxes on it. Defining a variable annuity. So how is variable annuity different? It's a market style investment. So this is the variable part of that title. Okay, 2 styles of benefits. You can have a death benefit, and in a death benefit, you could have a step-up benefit, which is what's preferred, I'll explain it, or you could be a critical care element in it. The step-up in basis says this: I put $100,000 into a variable annuity, and the first year that I'm in it, the market returns 5% by the rules of the variable annuity. They always keep some of the gain. But on that 5%, I now have $105,000 in there, and the insurance company says that's locked. If you die tomorrow, your heirs can't get less than $105,000. In year 2, the market drops, and your value goes down to $102. Your death benefit's still $105. In year 3, the market goes up by 20%, okay? 20% of your $102,000 says you're up another $12,000, so now your account's sitting at about $113,000, and they lock that in. That's a step up in basis, and you want that in a variable annuity. Otherwise, there's no purpose in buying the variable annuity because it's not giving you any protection. And I think that a variable annuity should be purchased with the idea that someone else will probably wind up with this money, and I just don't want to cheat my heirs. With a critical care element, what they're doing is they're saying you put $100,000 into a variable annuity, and they will guarantee a certain amount of that as something you can draw if you ever wind up in long-term care. And long-term care is defined as there's 2 activities of daily living that you can't perform. So my aunt right now is 98 years old, and she currently now has to go into assisted living. Because of a fall, she's no longer mobile, she can't dress herself, she can't bathe, so she's failing at least 2. So if she had an annuity with a critical care rider, she could start to draw money from the annuity to pay for her critical care. That's what those are. And those have become very popular as of late because people have been turned off to long-term care insurance, and they're saying, but what if I never use it? This is an alternative to it. Because if I never use it, well, then my heirs inherit all the money. If I use it, they inherit less, but they're still going to get some minimum guarantee in there, a death benefit. Income generation is the other one. We annuitize them to turn them into benefit. If you bought a variable annuity for an income benefit and you are not drawing the income, you probably should. Because that's why you bought it. You bought it to make the insurance company pay you a stream of income. And you get it in 2 forms. Either they guarantee to pay back everything you've put into it, and then you can continue to draw if there's still money left from appreciation, or they guarantee you a life payment for the rest of your life. Now, when you do a life payment for the rest of your life, that greatly reduces the amount they're paying because you're asking them to take the risk. But that's variable annuities. Do's and don'ts. Do allow for taxes at distribution. Fixed or variable, they're taxable. Don't surrender early. That's the worst thing you can do with an annuity. Find some other way to get around that and wait out the period. Annuitize don't annuitize it. I just said, if you're looking for an income stream, you probably should annuitize it. That's true, but don't do it without consultation. You talk first to the insurance provider to see what their promise looks like, and then number two, you talk to your tax advisor because there's going to be a tax hit on that income coming out. All right. The other one that you don't overload. Don't overload with available cash. Don't overload in term length, and don't overload in too long of a term length. So I would watch people come in there saying, well, I got $100,000 sitting in the bank, and I want to put it all into a variable annuity or into a fixed annuity, and I want the best interest rate possible, so I'm going to lock it up for 10 years. If that insurance agent never asked them what the rest of their funds were and where they were, they could have taken all the money that person had and locked it up for 10 years. And now 5 years later, they come back and go, I misjudged, I need some of that money. Now they're going to pay a surrender charge. So don't ever do it without consultation on both the vendor side and the tax side. Variable annuities, do remember what you bought it for. If you don't remember what you bought a variable annuity for and you have it, sit down with somebody and have it analyzed. Doesn't necessarily have to be the person that sold it to you, but get somebody to analyze it. If you bought it for growth or death benefit, then don't annuitize. Okay? Don't annuitize it because you bought it to give to somebody who's going to inherit it. If you bought it for income, make sure you take it because that's why you bought it. Don't buy a car with a really fancy radio and never turn the radio on. You paid for it, so use it. Consider what influences you. If it's fear of the market, don't go to a variable annuity, because you're still in the market. No matter what they tell you they protected, you're still in the market. So it's going to fluctuate. If it's fear of risk, then a variable annuity is not the right product because you still have risk inside that annuity. If it's for a guaranteed inheritance, the death benefit, you need to understand that the death benefit is taxable. They're not going to get out of it just because you died. And an enhanced death benefit is critical because if I don't have the enhanced death benefit, the insurance company is just saying, yeah, you gave us $100,000 when you die, we'll make sure your heirs get $100,000. Anybody can make that promise, okay? As long as you live long enough, I'll be okay. That's it. 5 more minutes for questions. I have an appointment at 1 o'clock with someone who I need at least 15 minutes to get there, but I will hang around for at least a half an hour and answer questions. I know there were a lot of them. If there are any general questions right now, yes?
If there's some reason why one should not donate money to dependents like children, to take advantage of the $15,000 per person per donor, how they may be invested or the competitor vehicle to be used.
The question is about gifting money to dependents, to children. Right now, it's up to 16,000. It's an odd number. It's $16,888, I think. We all remember when it was 10 and then it was 15 and keeps going up. The question on whether you gift money to a dependent or not, I think the two most critical ones that I always ask my clients was, one, how much money do you have and what are your needs? Because before you give money away, let's talk about what your needs are. Because once you give it away, is your child going to give it back to you? You give them $16,000 a year for 10 years, and then all of a sudden you have a health problem and you need some money, and you call them up and go, I need some of that $160,000 back. You're going to have to trust your children at that point, and that's the second thing. So the first one is, what are your needs going to be? And number two is, how do you feel about your kids? I'm not talking about do you like them or not. We all love our kids. Even when they're bad, we love our kids. The question is, what are they going to do with the money? Because if they're spendthrifts, then don't gift it to them. Okay? get some other agreement. Make it a loan, make yourself, let's say that I will get something for you, but you need to talk to me about what it is you want. You make the purchase, don't give them the cash. If your kids are not spendthrifts, if they're frugal, yes, gifting money while you're still alive reduces your overall estate. But before we get excited, right now there's no estate taxes at all. How many people believe that that will be true 5 or 6 years from now? Me too. We're either going to go back to taxing estates at certain levels, or we're going to take away something that you guys all love, that your heirs love. Never helps you. When you die and your heirs inherit things that are not in annuities or IRAs or retirement, where the taxes have been paid while you're alive, they get forgiveness of all the appreciated gain. So I buy my house for $70,000 back in 1970. I live in it till the day I die. And when I die, it's worth $450,000. My kids get that. Do they have to pay taxes on the gain? No. They get it free and clear. My stock portfolio, the same thing. So when you're talking about gifting, it's really critical. Who's getting it? What are they going to do with it? But first and foremost, what are your own needs? Don't ever shortchange your own needs. I watch people give generously to their kids, to have their kids live happy and large, but they were living on a shoestring. And that's just not the right way to do things. That was a great question, thank you. This is why he sat right in the middle, because he had all really good questions. I thank you for putting up with me for 2 hours again.
One last thing.
Yep, one last thing.
In appreciation for your wonderful presentation this morning and all the time and effort you put into it, the Retirement Association has this beautiful little portfolio for you.
Thank you. Bright colors. Thank you very much. As you can tell, I am a ham. I do a couple pro bono issues like this every year because I just can't give up that old 25 years of teaching. I just think it's so important. What drives me is to solve other people's problems. That's why when I left, I volunteered for SCORE, because I feel like I'm still getting to do that. I'm looking at a room full of people that are retired, and I'm betting that a lot of you have all kinds of traits and abilities and skills that you aren't even aware of. If you're looking for something to do, SCORE here in Madison is always looking for volunteers. It's a very rewarding career. When you go in there, you can work as hard as you want or as little as you want. All I'm going to tell you is the more they see your face, the more they're going to ask you to do. But if you're thinking about it at all, we'd love to have you on. Thank you again.